Real estate is one of the most reliable ways high earners in this country build generational wealth. And most of them cannot access the capital to do it, not because they do not have money, because every source of capital they have is locked behind a penalty, a risk, or a wall. Their 401k, penalty gate. Their home equity, risk their primary residence. Their savings, too small for a down payment on anything meaningful. A bank loan, debt to income ratios that ignore high variable income. In this video, we are going to show you exactly how the high earners we work with are buying duplexes, commercial buildings, and rental properties without touching a single dollar of their retirement savings, without a bank application, and in some cases in less than 2 weeks from decision to closing. Let me show you the 4 capital walls every high earner runs into. Wall 1, the 401k. Most high earners have $300,000 to $600,000 sitting in a retirement account. They know they cannot use it without paying a 10% penalty plus ordinary income tax. In the 37% bracket, accessing $100,000 from a 401k before retirement costs $47,000 in penalties and taxes. The money exists. The access cost makes it unusual. Wall 2, home equity. A HELOC or cash out refinance puts your primary residence at risk as collateral. Most financial advisors tell their clients never to borrow against their primary home for an investment property. If the investment goes sideways, you could lose both. This wall is real. Wall 3, hard money lending. Private lenders and hard money loans exist for this specific purpose, but at 10 to 15% interest rates, short repayment windows, and origination fees, the property has to perform exceptionally well just to justify the cost of the capital. Wall 4, conventional bank financing. Banks use debt to income ratios that can disqualify high earners with variable income. The down payment requirement, 20 to 25% for investment property plus closing costs, means you need $70,000 to $100,000 liquid before the bank will talk to you. 4 walls, 0 accessible capital, and a real estate market that does not wait. Let me show you how Daniel got around all 4 of them. Daniel is a software engineer, 38 years old, $210,000 household income. He had maxed his 401k for 6 years and had a strong credit score. He could not buy a rental property because every dollar he had was in a retirement account or his primary home. He came to us at 34. We helped him structure an IBC policy with $3,500 per month in premiums. By year 4, his cash value was almost $167,000, earning dividends and growing with 0 market exposure. A duplex came available in his market, $280,000 asking price. Comparable units were renting for $1,400 per site. After mortgage, taxes, insurance, and vacancy reserve, the property would cash flow approximately $800 per month. He needed $70,000 for the down payment and closing costs. He called us. We processed a $70,000 policy loan. Within days, the funds were in his account. No credit application, no bank meeting, no penalty. His cash value is still almost $167,000. Continue earning its guaranteed rate and dividends throughout the entire loan period. Year 1 results. The duplex generated $9,600 in net rental income. Daniel used $425 per month, $5,100 for the year, to begin repaying the policy loan. His cash value continued compounding. By year 5, he had $105,000 in available loan capacity. Year 6, he bought a second property. Year 8, a third. Each time the policy loan funded the down payment. Each property's cash value repaid the loan. Each repayment increased his available capital. The IBC policy was his bank. After 8 years, Daniel has 3 properties generating $2,400 per month in net income and a policy cash value of $247,000 that he built without touching a single dollar of his retirement account. Let me put the numbers side by side so you can see exactly what the difference looks like. A conventional bank loan for Daniel's $70,000 down payment would require a 30 to 60-day approval process, debt to income documentation, and a 7% interest rate, $4,900 in annual interest paid to the bank. The IBC policy loan approved in days, no credit application, 5% interest, $3,500 in annual interest paid to the insurance company, which flows back into Daniel's policy ecosystem. But here is the number most people miss. While the $70,000 loan was outstanding, Daniel's $167,000 cash value continued earning guaranteed interest and dividends. And there's one more difference that matters enormously for future deals. The policy loan does not appear on his balance sheet. His debt to income ratio is unchanged. His ability to qualify for a conventional mortgage on the next property is completely unaffected. Here is the system Daniel is running, and that many of our clients are now running. Step 1, fund the policy. Consistent premiums build cash value at a guaranteed rate. Every dollar that goes in is earning interest and dividend from day one. Step 2, take the policy loan. When the right real estate opportunity appears, request the loan. Funds in days. No approval. Cash values stay intact. Step 3, invest in real estate. The down payment is deployed. The property acquired. The rental income begins. Step 4, repay the loan. Use rental income to make systematic loan repayments. With every payment, the collateral is released and borrowing capacity is restored. Step 5, repeat. The cash value has never stopped growing. The repayment has stored the available capital. The next opportunity can be funded sooner than the last. The key insight is this: at every step in this cycle, even while the loan is outstanding, the cash value is compounding. Your money is working in 2 places at once: in the property generating rate, in the policy generating guarantee growth.
I want to tell you about a client who came to us from a very different angle. She was a nurse practitioner, 44 years old. She had a rental property she had purchased years earlier using a HELOC on her primary home. The property performed well, but she had always been uncomfortable with the arrangement. Her home was collateral for an investment, and that bothered her. When a second property opportunity came along, she reached out to us, not because she did not have ideas, but because she wanted to do it differently this time. She wanted the investment capital to come from somewhere that was not her house. We designed an IBC policy for her 3 years earlier, primarily for life insurance and retirement income planning. She had over $121,000 in accessible cash value. She took an $80,000 policy loan. The second property was acquired. Her home never entered the conversation. She told me the first property always made me nervous because I knew what was behind it. This one I can sleep next to. And she laughed. 3 years later, she used the same policy to fund a renovation for the first property, increasing both the rental income and the market value. Her IBC policy is now her primary capital source for every real estate decision she makes. Not her bank, not her house, her policy.
Real estate is not complicated when you control the capital. The IBC policy is not a workaround. It is the vehicle that the system never told you existed. You want to understand the exact loan mechanism that Daniel uses, how the cash value keeps growing within the loan while the loan is outstanding, and how the repayment cycle builds accelerating capacity. Download our free guide, Policy Loans, the one financial move that lets your money work in two places at once. The link is in the description below. If you are between the ages of 30 and 55 with a gross family income of $150,000 or more, visit infinitebankingsimplified.com to book your complimentary strategy call. We'll show you what a policy size for your real estate goals looks like, including the timeline to your first accessible loan and the cash flow required to build it. In the next video, I want to share something Isis and I rarely discuss publicly. What we have actually learned from designing thousands of IBC policies over 18 years. What works, what surprises people, and what destroys a policy that would have performed beautifully. Subscribe so you do not miss it. We publish every week.